Good morning, everyone. If you could indicate in the chat line that you hear me, I would appreciate it. Okay, thanks, Cole and Sean. Okay, the session's being recorded as normal. Today we're going to begin our coverage of the course with the beginning of chapter 4. We will, I'll make a few comments around that particular chapter, and we will work problems for the balance, if you will. You will notice, however, in Learn that assignment 1 is now posted in the Dropbox. It's open to you at 11 o'clock this morning and will remain open to you up to your submission on or before April the 9th. There's no class next week, as you will recall. It's Easter Monday, and the college does not operate on Easter Monday. So you have no classes, so it'll be probably 2 weeks before I'm online with you again this way. However, in the interim, including the weekends, if you have any problems that you're working out at the end of chapter and are not coming to the same answer that the book has given you or that's posted in Learn, realize the ones in Learn have been updated with a few corrections over those in the back of the book for as far as answers go, simply because they are a few of those quoted in the appendix at the end of the book are in error. Not many, but a couple. So you should check both places if you're not getting the correct answer at the end of the book. And we will, as I say, work problems here for the most part today on chapter 4. You will have a quiz on chapter 4 in 2 weeks from now. I'll put out a notice to that as well as a notice to assignment 1. So I will do that by email as of probably shortly after this lecture or later this evening. But as I mentioned, if you're working problems, please, if you would like, submit your work to me and I will take a look at it as my time permits and try to get back to you. In some cases, it might be just an exchange. Today, it just might be an exchange of emails to remedy the problem. In other cases, I may ask you to join me in my Learn room, if you will, and we'll discuss it that way. I find sometimes, well, maybe quite often, that's a better way to do it rather than a lot of back and forth of email, which can be incomplete at times. So anyway, please send that in, including up to our next, well, continuing onward actually until the end of the course. But this will include over the long weekend as well. I will be maybe not at my workstation hourly on an hour basis, but I will be checking in and out of it over the long weekend as well. And if I can handle any of your questions at that time, I will. And you're right, there is no quiz today. We've done quizzes 1, 2, and 3. And I felt we should at least work a few problems, and through working the problems we talk, or I will talk, you can ask questions about the theory, if you will, and that plays into the quiz as well. But the quiz number 4 will be about the theoretical material in chapter 4. So we'll do that when you come back from not that you've gone anywhere, but we'll do that when you when we resume our classes 2 weeks today. So I just want to check. Someone speaking to me, or is that just an open mic? Yeah, no. Go ahead.
Do you have any idea when you'll be done with the midterms?
No, I don't. I do know that I will be making prints. I have yet to do it. I have 3 midterms to mark, and my goal, although sometimes goals are not met, my goal is to have it out to you within, won't be this week, but potentially next week. I'll have the grades posted to you in Learn, if you will. And then I'll set up a special session in an afternoon somewhere to go over the questions for you. Keep in mind this course is very dependent on previous chapters. So just because we've completed chapters 1, 2, and 3 does not mean that's the end of them. What you've learned there is now put to application, if you will, in chapters 4, 5, and 7, if in fact we get that far. I'm finding right now this online delivery is challenging our ability, my ability perhaps, but maybe our ability to cover all of the material. So the last chapter may be a little bit short. I'm hoping not, but it'll just be what it is. And of course, if I don't deal with it in class, you won't be you won't be expected to see any questions in that regard if it's not covered. So to answer your question more directly, it will take, it was Kelly, I think, it will take my goal again is to have it back to you next week. With the long weekend, I'll have lots of time to do some marking there, I believe, and that's my goal. Okay. Let's talk about chapter 4. It deals with comparison methods, and actually so does chapter 5. It's just that the author has chosen to use what's referred to as the internal rate of return method and handle that as a separate chapter. So right now we're going to deal with comparison methods, but we're going to be using the present worth method, the annual worth method, and the future worth method, although it is not used that often as a means of doing comparisons. There are a few occasions where it does make sense to do that. That particularly deals with situations in the future where you're wondering how much money due to a monetary investment you might have in the future using one method versus not method, one opportunity versus another opportunity, and which is the better or best of 2 or 3 or 4, as the case may be. And the last one we'll deal with is called the payback period. We won't spend too much time on that. It's pretty straightforward to understand. It's a process whereby interest is not normally included in the process at all. So it's void of an interest component. And it's basically trying to find the break-even point. If you spend $1,000 on a piece of equipment, how long will it take to recover that $1,000, excluding the interest component? So it goes pretty quick, that one, and the formulas are pretty straightforward, but we'll wait till we get there to give more detail. In the course right now, though, for chapter 4, there's some assumptions the textbook makes, and I think it's worth repeating them before I get in. This is some of the theory, mind you, but we're going to assume that all costs and benefits are measurable in terms of money. That's not always the case, of course, in the real world. Some things cannot be measured in money. For example, safety at the work site. It's hard to put a value on what it costs due to an injury or due to a death, things of that nature on the work site. Also, there's situations where we don't really put a cost on environmental impact. There's another example. So that is the case, but we will make the assumption in this chapter and following through the book that we will measure all of our costs and all of our benefits from those investments in terms of money. We will also assume that future cash flows are known with certainty. And of course, we don't know the future of cash flows. We believe we can calculate and make a pretty good estimate of a salvage value down the road or some sort of return from a clientele in 5 years from now or 3 years from now, and we will make those as statements in these questions that we deal with. And in doing so, we will assume they're known with certainty. The reality is that's not the case. That can be handled, however, by using I'm trying to think of the word here they have, but it deals with, just give me the minute here and I'll find it because I think it's important. It deals with uncertainty and risk. So we can, through methods using dealing with uncertainty and risk, come up with robust decisions. But we will make the assumption right now that we know the future amounts with a degree of certainty and deal with that uncertainty that does exist at a later chapter, one of which, however, we do not cover as an introductory course. We're going to assume that cash flows are unaffected by inflation or deflation. Again, that's not the case, but we're going to start out with the introductory course by making that assumption that inflation is zero and deflation is zero. It has no impact. Unless otherwise stated, we're going to assume that there's sufficient funds available to undertake a project. Sometimes that's not the case. The clients you have a limited amount of money. It's not a bottomless pit. And this as well can be handled, but we will make the assumption that unless we're told to the otherwise, our clients, our own funding, we have sufficient to make investments or to do work for clients. We're going to assume that taxes are not applicable. And again, that's not true. Of course, we have our provincial sales tax and the goods and services federal tax. Sometimes they're combined into what's called a, can't get the adjective I want here, but anyway, a combined tax between the two. They're harmonized, that'd be the word I can use. That is the reality, but we won't look into that. And we're also not going to deal with corporate income tax in our introductory course. The reality is these things can be handled, but they're going to be reserved for a more they're going to be reserved for a later time in your studies if you go into more than an advanced course on comparison methods and cash flows. And the last thing that we're going to assume is that all of our investments, unless we're told to the otherwise, will have a cash outflow at the very beginning. Day one, day zero, now, today, we will have a cash flow that is outflowing. And we will often refer to that as a first cost. So you see the word the first cost, that's telling us that it's occurring at time zero. We will also assume that the project with first costs have cash inflows after the first costs that are at least as great as in total the first cost. In other words, there's going to be a return in that money. So these are the 6 assumptions. They're in the textbook. I've just sort of glanced at them as I'm speaking here, and you should be familiar with them. I also want to go on and mention, though, that we're going to be looking at different, we'll say, types of relationships that are amongst projects. Projects generally, or perhaps even more than generally, projects can be categorized into one of 3 categories. The relationship between projects that you are comparing may be independent. By independent, we mean that the cost and benefits of one has no no similarity or sharing of cost and benefits with the other. They stand separate. To use the words, 2 projects are independent if the expected cost and expected benefits of each project do not depend on whether the other one is chosen. So they are then dependent. The examples they use in the book, and you'll read through it if you haven't already, you probably should have already, but if you haven't, if you're buying a computer and you're buying a vacuum cleaner, there's no relationship between those sort of items, one being one being totally independent of the other. There's no commonality of cost or benefits. So in those cases, we would deem them independent. And in other cases, the projects could be classified as mutually exclusive. And by that, it means that if the process of choosing one of a number of alternatives, be it 2 or 3 or 20, the others are excluded once you choose the one. So mutually exclusive just simply means you're going to choose ultimately one of them and the rest as if they were never considered in the end. But you have to go through the process to choose which one is the better of the two. And those are referred to as mutually exclusive projects. And the third category is one that's referred to as related, but they are not mutually exclusive. And that's often when one project is highly dependent on another project. And again, the examples that they use in the textbook, I think they talk about building a shopping mall on the city outside limits along with a parking lot. Well, you would have the option of doing neither, do nothing option. You could build the parking lot. Excuse me, I'll back up. You could build the shopping mall. That's fair as a standalone project. You could build the shopping mall with a parking lot. That's reasonable, but it doesn't make a lot of sense simply to build or construct a parking lot with no shopping mall there. Nobody's going out there. Why do you need it? So through common sense, you could conclude then that there are going to be certain projects that they're related, but they are not mutually exclusive. So there will be conditions that might be set where they would not, conditions that might be set where it doesn't make sense to do one of the options at all. And we will look at a couple of those sorts of examples as well as we go through the material. There are examples in the textbook that they help to explain these three types of relations amongst projects. And the last comment I want to make is what's referred to as the minimum the minimum acceptable rate of return. You will know that as MARR, M-A-R-R. And that is a number that basically is deemed to be or is considered to be, or the reality is, it is an interest rate. Companies set their own MARR. They don't calculate it per se from the work we're doing. It is simply a value that a company puts on its worth. In other words, a project has to return a minimum acceptable rate of money, because if it doesn't, then if it invests in lower projects, then they're consuming their resources and then have to forego better projects or projects that give a better return. So a company might have a MAR of 10%. That doesn't mean you couldn't make money off of it and make 5% profit on your investment, but companies will set this as a minimal acceptable level for undertaking a project. And the reason for that is that once they commit to a project that yields less than the MAR, they're utilizing their resources and spending their money when there are likely other projects to undertake that have a greater return. So companies will do this, especially larger projects. Also, larger companies may be more inclined to have a higher level of MAR than a smaller company. Nevertheless, most companies will have a MAR. They will not sort of say, well, gee, according to my calculations, I went out there and I'm going to make a 2% return on my investment. And in today's economic climate, that's horrible. I can do better than that. So I might have a MAR of 5%. In other words, I've got to have a 5% return on my investment to be viable or to be a chosen option at all. If it's under 5, then I won't look at it. I'll just simply say thanks, but no thanks, and look at other opportunities to commit my resources to. So that's kind of a very quick overview of what the MAR is all about. And again, the material, the theory behind it, the comments around it are in the textbook. So we're going to start out here by taking a look at the present worth and the annual worth methods for both independent and mutually exclusive projects. Related but not mutually exclusive, you will find when you read through the material, although it is a standalone category of classifying projects, essentially, after all is said and done, it boils down to treating the projects as if they are mutually exclusive by breaking them into component parts. So this textbook at no place does it attempt to work that through. You have the foundation to be able to do that by understanding what mutually exclusive is all about. So even though there's three types of projects, independent, three types of relationships between projects. One is independent, mutually exclusive, and related but not mutually exclusive. The mutually related but not mutually exclusive is not it is not invested. It is not examined in this textbook beyond the fact that a realization that you can have projects of that nature and the statement that in order to deal with them, you are fundamentally treating them as if they are mutually exclusive by dealing with component parts of the related but not mutually exclusive projects. You will find in the back of the textbook now, it's going to stipulate the comparison method to use. So if it says use present worth method, you must use that method. If it says annual worth method, you must use that method. If it says future method, and that won't be as often, but it can occur, and including in the examples we do, or even on an exam question, you must use that method, even though all of those methods are viable on any one of the projects that we deal with. So the textbook will focus on doing projects primarily, though, with present worth and annual worth methods is what it's going to focus on. But we'll have a little deviation from that as we go through some of the material. Secondly, you'll find in the statement, and this is important, in the statement of a problem, and this is important because you will need to know, are the projects we're dealing with more than one, otherwise you wouldn't be doing a comparison, are they independent or are they mutually exclusive? Normally, it'll be stated in the question, but some questions are worded in such a way that the implication is that it is one or the other, and you'll have to kind of draw that out of the question. So those are a couple things to keep in mind. I think the most important one, it will be the idea that they will stipulate the method. So if it says compare these projects using the present worth method, and you decide you're going to use the future worth method or the annual worth method or even a payback method, then you would get 0 for that question. Okay, so please be attentive in the question, and they will state which method of comparison you should be using. And that will also expand into the next chapter where we're going to be dealing with the internal rate of return, which is a special look at how we're going to proceed with that method as well. It's a dedicated chapter to it. So those are the comments I have. So let's just take a look at some of the projects that we can work out here. And we're now at end of chapter, and I'm going to be using my document camera to work these out. And in the asymmetric lectures, asynchronous is a better word there, the asynchronous lectures that are online for you, I have referenced a number of examples that we should do. You should do as many as possible from the end of the chapter. If you're some of them are rather complex, but nevertheless, you should try to do as many as you can because it will give you more and more comfort in dealing with these sorts of comparisons. So we're going to take a look in Chapter 4 at problem 4.4, which is pretty straightforward, I guess. And it's about Margaret. She has a project with a $28,000 first cost that returns $5,000 per year over its 10-year life. If it has a salvage value of $3,000 at the end of 10 years, and her MAR, in order to undertake work, is 15%. So we are going to now use the MAR as the interest rate. That's how we're doing this. And if the outcome is positive, then it's telling us that we are achieving MAR. If the outcome is negative, it is telling us that we are not achieving MAR and should not be considered. As you'll see in that project, it says if the MAR is 15%, so you're given that, what is the present worth of the project? So that's telling you right there, you must use the present worth method to solve this. Okay, let me bring up my document camera for you here. And in order to do that, that's okay there. So I'm going to write EOC 4.4, top right-hand corner. And if you are not seeing that, please let me know. Okay, you're not seeing it yet, and I think I can understand that, so you will see it here shortly. Thank you for taking that out, and you should now see it. You okay with that? Yeah, sorry about that. I had brought up my document camera on my screen, but I had it on the wrong screen in terms of, and had not indicated which screen to use for you to see it. So there it is there now, and as indicated, 4.4. So you should all see that at this moment. Thanks for responding to that so quickly so that I can get it back on track. So once again, here we are, you're doing a cash flow diagram, just like the previous chapters that we worked with, starting in chapter 2 and chapter 3, we are using cash flow diagrams. And we will continue with that. So we're going to show here a cash flow diagram. You should try to be thinking a little bit ahead of me here when you can, but in 4.4, it appears as if the timeline we are working with here would be 10 years. So I'm going to draw my timeline here. We'll call it 10 years. Time 0 is back here. And we are having a first cost, and there's that phrase, the first cost. So that's telling us it's happening at time 0. We're making that assumption. That will be the case. There are other instances where that may not be the case, in the sense that you'll have multiple cost, for example, or multiple reflection on that. So if you're paying someone to do the work and that's a cash outflow, you may pay them on an incremental basis. In other words, you may pay them a certain portion of the overall contract that you have for them to do work for you, if that were the case, on a schedule basis every 2 months, every 4 months, or whatever. So in that case, you'd have others here. But for us, we are going to deal with a first cost, and that will represent the cost of the project. As we get more into advanced studies, we don't do it here in this course, but some of the costs that come out will be based on sort of a multiple of outflows of cash. We do touch on it ever so briefly, though, I will point out in 1 or 2 of the problems, just so you get that exposure. So we have that, and in this question here, this is for $28,000. And the returns will be $5,000 per year. So right away, we should recognize that with that type of project, we will have an annuity. And that annuity is a return. As it says in the question, it has a $28,000 first cost, that return. So that's money coming back to Margaret, $5,000 per year over that 10 years. Now, again, I've seen some of this where make sure you know how to draw the annuity correctly. It's a diagonal line, usually going to the end of the first year, and then it runs parallel to the timeline to the end of the timeline. And it is $5,000 per year. In addition to that, we have a cash flow here of a salvage value, and her salvage value in this case is 3,000. So it's under the 5,000 to maintain some level of relativity in our scaling. So it will be 3,000 here. So her MAR is 15%, which is her I. So I is equal to 15%. So when we work our calculations out, we're going to be using the interest rate of 15% to determine, does this project achieve or not that 15% return on the cash flow, through the cash flow. So this one's pretty straightforward. We could approach it by treating each of the three cash flow elements here, the initial first cost, the annuity of 5,000, and the salvage at 8,000. We could treat all three of them as a separate component in the overall formula, and that's usually how most people would do that. However, when you see a salvage value here and an initial cost, you can also go to the capital recovery formula as an alternative. I'll use the first of the two that I just mentioned to you, but you can combine them and essentially work with two components. So the present value, and note that as we do it here, the problem asked us to do it. It told us, it stipulated, use the what is the present worth of the project. So we have to use that method. If you were to use any of the others, then you would be, you're not going to get marks for it because it's calling for this method to be used. So the present value is going to be equal to the first cost. I sometimes abbreviate things, but first cost plus the annuity. And we've got to convert that annuity into a present value. So it's going to be, what is P? We know A, I, and N. And then we're going to look at the salvage value. Well, that's a single future cash flow. So it's going to be plus F, the future value, if you will. And it will be, what is the present value, the equivalent of that, if we know the F and the I and the N. And that would be, if you will, the factor equation that we have to deal with. So we still don't know, can we use the tables or not? But when we take a quick look at it, we're going to learn that we can, because we know I is 15% and we have a table for that. And we know N is 10. And within that table of I equal to 15%, there will be an N value for 10. So we can use that. So we'll put those values in here. Now we have to carry signage here. It becomes important. The first cost is a minus 28,000. Not that there's a big factor here, but I'm just kind of screwed up on my equal signs there. I'll just rub that out, put it in here again. Plus the annuity, which is 5,000, onto PA. What is P slash A? I is 15%, and N is 10. Plus the future value, which is 3,000. What is P? We know F. I is 15%. And again, N is 10. Whoops. N is 10. So again, now if at this stage we realized, after writing this line out here, we realized we had to use prime formulas, we would have had to substitute in the prime formulas where it was necessary. But we don't have to. It's not wrong to do it that way. And if you do, I will mark it accordingly. But it will take you longer to do the question, and you introduce the probability, the possibility of perhaps some arithmetical errors that you might not have made if you're using the tables, because the tables actually eliminate some of the calculations that you undertake. So let's take a look at this. And what do we have here is the minus 28. Not much we can do about that for the moment. So we're going to leave it here. Plus the 5,000. And what is this factor? Well, if you look that factor up in the back of the appendix, and you should do that to become very familiar with those compound interest factors, 5.0188 and plus 3,000 onto 0.24718. If we do all of that, we could do the arithmetic and we will come up with an answer here of minus $2,164.46. So what's happened from that? Well, it's pointing out a couple of things for us. First of all, this project will not achieve the goal of 15% return. This is negative. If it had been 10%, it might have been positive, but Margaret's MAR was 15. We have to work with that. Just like your company, if they're using engineering economics, will have its MAR level, especially larger companies, even medium size. If you're a two-person outfit, you may not be doing that. You'll just take whatever you can get your efforts into, and you'll just go with it. Big return or low return, doesn't matter as long as you're not losing money, you might say. In that case, I guess you could argue your MAR is like 0% in that regard, but not quite. So that's telling you that this project is losing money at 15%. Well, I won't say that. It's poorly worded on my behalf. It's not that it's losing money. It's that you are not achieving your 15% return on your investment because you have set 15%. Margaret has set 15% on that return. So that's something to keep in mind there. Alternatively, no, wrong word there. In addition, if Margaret had another option with a project that returned different amounts, you would calculate out the present value, and it may be you would then compare the two end results and you take the one that's the highest. These are independent projects. They're not mutually exclusive I'm talking about here. Mutually exclusive is handled in a different way. So that's the end of that one for 4.4. Let me just check. There's no comments coming in around it, I don't think, on it. So if that's the case, that's good. Okay, let's take a look at the next one that I've designated, and that'll be 4.5. So it'll just be the next one in this stream of projects, problems to solve. So EOC 4.5. As usual, if by chance I am working outside the camera view, please let me know to move my camera or my paper or something, cut in on the audio line to say that so that we don't lose time. I don't, as I'm working always, I'm just simply not looking at the chat line at all times. I just glance at it every once in a while. So don't let me go on and on and on if you can't see what I'm working with, please. So 4.5 is really not a lot different than the one we just did, but it has a slightly different angle to it. So we'll take a look at that. And here we go with this one here. What we have here is a 4.5 is Nabal is considering buying a house while he is at university. We could say college just as easily. The house costs $200,000 today. renting out part of the house and living in the rest over his 5 years at school will net after expenses $2,000 per month. He estimates that he will sell the house after 5 years for $210,000. Nable's MAR is 6% compounded monthly. Should he buy the house? Use present worth. So again, it's telling us which method to use. So we must do that. And we first start out with our cash flow diagram. And it appears from the question we should be able to easily conclude that the timeline we're using is 5 years. That's the amount of time where Nabel is at school, assuming he doesn't flunk a year, and that he will be buying it as he starts his school, and he will be selling it when he finishes his 5 year of schooling. So we're going to throw this in here, and it will look something like this. If I get it right, I'm going to drop it down just a little bit. So 5 years. No real need in a question like this to subdivide it into like graduated marks showing each year. That's normally not needed. Occasionally the question will implicate you or would indicate you must do that. But we're looking here at 5 years. Time zeros are way back here. And we know that Nabel has spent as his first cash outlay, his first cost, and this is $200,000. Okay, I'm just going to come down here about 2, 4, 6 of these. So we have this at 200,000, and he has this cash flow situation within the question that indicates that after he pays for certain things, who knows, internet services, lighting, heating, I don't know, yard cleaning, whatever the case may be. But then he also will charge the people staying there, and the net effect of all of that will be $2,000 a month. So the $2,000 would represent his income from his tenants, and it would represent also the taken away of that from that income his monthly expenses, whether that's as I say, internet services, it might be electricity, might be natural gas, whatever they are, water, those sorts of expenses. So effectively the net effect of all of that will be an annuity. I'm going to draw that right here. I tend to just do it this way here. Doesn't have to be precisely at the end of the first year, but that's the implication. It'll be at the end of the first year, that diagonal line. And you have it continuing here. So what do we have here? We have $2,000 per month. And after all is said and done, he's going to sell it at the end of 5 years. And he believes with the market value, he's going to get a return of $210,000. Now this one's a little different, but fundamentally, mathematically, it doesn't matter. Usually your salvage value is notably less than your initial cost. But in this case, we can still treat this as a salvage value. It's just that the value of the house is appreciating, not depreciating along the way. So it's the same approach we can use as if it were a salvage value. It's just that he's going to sell it at a higher value than what he cost. However, over that 5 years, interest is a factor. So that seems to be the numbers we have there. And we know his MAR is given in the question, which we know is equal to I, is 6%, but it's compounded monthly. And that makes that a nominal amount, 6%. We can convert that into an effective interest rate or a sub-period interest rate. If it were effective, we would probably convert it to the year. If it were monthly, we would convert it to the month, if you will. And when you look at your other data in the question, but in particular this one, the $2,000 per month, if we convert to a sub-period monthly, then we have compatibility with that number. That's important to recognize. If we decide to calculate IE, I subscript E, we're going to have to convert this annuity of monthly into yearly. That's a more strenuous calculation. It'll work, but you will be introducing more steps, more arithmetic, and the likelihood of making a mistake along the way. So if this is the case here, we're going to do the IS, which will be 6% divided by 12. I should have put in here, and I think I will because you're writing this down and you may want to refer back to it. So I'm going to erase this little equal marks here and put it closer to this and put here R over M equal to, again, I didn't do that well at all. So bear with me, please. I'm just going to rub that out just so that it's clear when you're copying it down that you're not doing it incorrectly. R over M, which is equal to 6% over M, which is 12, which tells us our interest rate is 0.5%. And as a fraction, that would be, you could state that as a fraction, but this works equally. If we have to convert it later, we will. We won't have to. But if we did, we could. Now also though, because our interest rate is now monthly, so it's 0.5% monthly as a sub-period interest rate. The annuity is monthly. That's good. But the years, the timeline is years. So we're going to have to convert this to 5 times 12, which would be 60 months. Remember, once again, we need that compatibility of units. Now we have the interest rate in months, the annuity in months, and we have the duration in months, the timeline. So we're good. So let's just take a look at our formulas here. They said we must use the present worth or present value. I tend to write it that way. It means the same thing. We're going to have the first cost element. It's a minus 200,000. Plus the next one, which we'll say is the annuity. It's a return, so it's plus a plus if you like. It will be an annuity, and the question will be, what is the present value of that annuity? If we know I and N, plus the future value, which is a single amount. It also is a plus, so it will be what is P if we know that future value, I and N. So there's our factor formula, if you will. And we can now put some values in that. Again, looking ahead a little bit, do I have to use the prime formulas? Well, no, you don't, but it is possible. But I'm looking at this. I know the I is 0.5, and I know I have a table at 0.5%. Good news. I know N is 60, so I don't know that in the top of my head. So I'm going to take a quick look at that table here. This is at 0.5. You might be able to see a part of this as I'm going through it. 5%, 0.5 is right here. And as we look at this, on this, we're saying here 0.5. And we have an N equal to 60. So we kind of got lucky. It wasn't 58 or 57. They have 55. It jumps to 60, but we have a 60. So the factors can be extracted from the tables. So we will use them. And that is always your first choice, or should be your first choice. If you put in the prime formulas, again, I know I'm repeating myself, but the arithmetic will be longer. The potential for making a mistake will be longer, and it's going to take you more time. And again, on an exam, what I try to gauge is that you're using the most efficient way to solve the problem. In this case, using the factor formulas, and I don't allow for the fact that you may have chosen the other. That's going to take you time, and if you're, I guess if you're fast at your work, you can do it and get away with it. And if you do it, I'll mark it accordingly. You get marks if it's right, and you won't get marks if it's wrong. But in a case like this, I would highly recommend the use of the factor formulas. So let's take a look at this. Next step here is minus 200,000. That nothing we can do with that just yet. A, we said, is 2,000 onto what is the present value of, if we know that I is 0.5% and N is 60. Plus F, which is 210,000. What is present value if we know that future value? I, which is 5%. (0.5%) and N again is 60. So now it comes time to turn our attention to the tables to determine the factor for these two components of the overall equation. So again, not much we can do here. We're still going to keep carrying it. Don't forget that your first, anything below the line is it is a negative. It is a cash outflow. Above the line is a positive. It is a return, a receipt to you, positive. And now that we're doing these types of comparisons, we need to maintain, if you will, the signage involved in this. So we're going to have plus 2,000 here. PA at 0.560. Just give me a minute here, please. Okay, if you look that number up, you should get, I believe it's 51.726. I'm assuming some of you at least are looking this up as we go along. I realize it's moving pretty quickly, but I assume you are. And that if you have a different factor than I'm putting on the sheet, please advise me. Plus 210,000 onto that factor, which is 0.74137. Okay, sounds good. If we do all of that arithmetic and watching the signage, we should end up with 139.70. So this is telling us now, and it's a plus, that it is earning us the 6% compounded monthly interest rate, or MAR level, because this number is positive. And this is what it's returning at that rate, $59,000. So this is a good investment. So you're going to find when we're doing questions like this, in addition to me saying your work must include a cash flow diagram, you will also see on the exam, it doesn't do it in the back of the textbook that often, but what is your reasoning? Why is this a good or is this a bad investment, and why? So you'll have to get ready for that. But this is showing that that the return on this investment in terms of its present value for the investment is $59,139, and it is achieving, if you will, because it's a positive number, the 6% compounded monthly MAR. So who's the Naval? Naval's the guy here. Naval has achieved this, this rate of return. Okay on that one. And we could also do these problems, you'll find, using the annual worth method as well. Now, the questions did not ask for that, but we will encounter some where you're going to have to do that. So the annual worth methods would be similar. It's just that you would take all of the amounts and bring them to annual worth. So going back to this diagram, we're not going to do it here, but I just want, you would convert this present value. You would convert this, the present value here of 200,000 into an annuity. And you would do the same thing for your future value, convert it into an annuity. And then you would add up all of your annuities. This would be a negative annuity. This would be a positive, and this would be a positive. You'll come out with different numbers completely, but the same conclusion. Because the number you come up with now will be the annual value, if you will, of this investment on a monthly basis, as opposed to, if you will, the present value. So you need to keep that into account. So you could get this exact same question, only the last line could say use annual worth. And if that were the case, this whole thing would flip over to that approach where this would be converted to an annuity. This would be converted to an annuity. This is already an annuity. So per month. And we would then sum those up, watching the signage, and come to the same conclusion as we do here. Different numbers, all completely so. Okay. So these have all been standalone projects that really don't seem to have another player on the field, if you will. So maybe now we can take a look at another project where that is the case. So let's take a look, if I can do this here. Let me just make sure I'm not getting ahead of myself here. Let's take a look at these two. Project number 4.6. I'm going to do EOC 4.6 as our next project. Where's the time? We're a little after 10. Okay. Okay. In this case, a young software genius is selling the rights to his new video game he has developed. Two companies have offered him contracts. Whoops, I'm sorry. I'm on the wrong project. I'm going to go back one. That's 4.7, which I hope to do next. But I'm sorry. We're going to do this one here. And it is Appledale Dairy is considering upgrading an old ice cream maker. Upgrading is available at two levels, the moderate and the extensive. So you have two options here. Which one, if any, do we buy? Does Appledale buy? Moderate upgrade costs $6,500 now and yields an annual return of $3,300 in the first year, $3,000 in the second, $27,000 in the third, and so on. So he's got some declining returns coming in here. The extensive upgrade costs $10,550 and saves $7,600 in the first year. The savings then decrease by 20% each year. If the upgrade if the upgraded ice cream maker will last for 7 years, which upgrade option is better? So now we have two options. So as I say, in addition for me asking you to provide cash flow diagrams, that would mean you have to provide two of them, one for each option here. It would also mean that I will ask which option, why should you choose the option that you decide to go with, which will be what I call sometimes a decision statement or a concluding statement as I word the question and add on to it to what you might find in the textbook here. Okay, so let's take a look at the first option here. Anything I'll maybe ask you before I go? I don't want to sit too long on the question, but with that cash flow, what type of cash flows seem to be present in this question? We're dealing with present worth comparison. That's a given. Anything coming to your mind right there? Let's just look at the first one. We're going to go to the moderate one. What are the cash flows associated with there? Gradients is a good answer. There's two types of gradients, which is for the upgrade, the moderate upgrade. What kind of gradient? It's an arithmetic gradient as put forward here. These are coming in privately. I take it for some reason that's how WebEx is working, and that's really unfortunate. Maybe that's got to do with when you if you're clicking on the chat on my cell on my on the layout of who's participating. Poor wording here. I wonder if you were to be putting it in, or maybe you are doing that, but you should be entering your comments in the chat box under where you can select to everybody. Hopefully that's why this is happening, but maybe not. I know there's been problems with this. I would send everyone if it was an option. The everyone option is not there. That's interesting. Appreciate that, Sean. I'm going to send in a note on that. Because when I see private, I don't always like to use names simply because they that might be of a some private nature is what you're telling me, and you don't want me to use your name. But I may break that rule a little bit here today to see if I can solve it. But I'm going to just make a note here to do a follow up with people on WebEx. Okay, I'll get something off to the help people on that. That shouldn't be happening. I don't understand that. Hope they haven't removed it for some stupid reason. Okay, nothing I can do about that right now. So we'll take a look at this. And this question is going to have two standalone options we're looking at. So let's take a look at this. We have here, we're going to have a cash flow here, and we know it runs for about 7 years. So you just draw a line across there. I don't think it has to be drawn to great scale, but 7 years is what we have here. And we know for the first option here that we're talking about here is that Appledale is going to cost Appledale for the moderate upgrade $6,500 now. So won't be too much here, but I'll drop this down here. $6,500 here. And it's going to give us a return, or yield's the term they use, an annual yield. So it's an annuity of $3,300 in the first year and $3,000 in the second and 27. So it's declining by $300 per year. Okay. So we have this return, and the return, the base annuity. I'm going to take that up just another level here, if you don't mind, because I know what's coming. And this will be your base. So this will be let's get my words here. 6,500, 3,000, 3,300 in the first year per year. However, as the years go on, it's going to decline by virtue of that arithmetic gradient. So it's going to look like this, if you will. And the gradient factor is G. I'll put it in here. Maybe I'll put it here. G is equal to minus 300. Can't have plus because plus would mean it's on the other side of the base annuity and it's growing. In our case, we are being told that the returns are declining. So it's going to be a negative gradient. So we have that. MAR, well, MAR is equal to I, the interest rate, which is equal to 8%. Now, it doesn't tell you anything beyond that. So we can simply assume that it is a per year basis. It's 8% per year. You could treat it as a, and go through the arithmetic, but you're going to end up back with 8% in this case for that MAR. So to put that into a perspective here, Appledale is saying that we're only going to upgrade if this project, these upgrades, one or the other, if in either, will achieve an 8% return on the investment. Otherwise, it's not worth it to us. We're going to just keep working with what we got. It's sort of a layperson's reflection on what's happening here. So the present value, and I'm going to put a little subscript here, M, for the moderate upgrade. That's just to distinguish it from the other one, which is an extensive upgrade. And it's going to be equal to the first cost. Onto plus the annuity, which is, what is P if we know A, I, and N, plus the gradient, and that is what is the annuity if we know that gradient, I and N. Now we have to recognize that when we take the gradient, we're going to convert it into an annuity. So once it is done into an annuity, we have to now move that annuity into a present value. So that would mean here, we have to multiply whatever we get from this component here by what is what is P if we know the annuity, I and N. So we're now kind of combining two steps or two factors together. We first convert the gradient into an annuity, but we can't leave it as an annuity because we're looking for present value. So we're going to have to multiply that, whatever it proves to be, by the factor where we're going to look for the present value of the annuity. The gradient will give us an annuity. The next step will take that annuity and give us a present value. So we're combining them into one. So let's put some numbers in here and see where that takes us. We have here minus 6,500 plus the annuity, which is 3,300. PA, I is 8%. And N, this is in years. The annuity is in years. Our time is in years. It's going to be a 7. Plus the gradient. Now the gradient, I'm just going to use a bracket here because it's a minus 300. Just so I don't lose track of that. I could have just changed that to a minus right here and achieved the same thing, but I'll show it this way. So we have here A, the gradient. I is 8% and N is 7. And we're going to multiply it by PA. 8%, 7. Squeezed it in there. So now that we have that, and we know from this, we knew 8%. We know we have a table at 8, I equals 8. And within that table, we know we have an N at 7. So we can use the tables once again, rather than involving ourselves with prime formulas. However, if for some reason the tables were not available to us, you must use the prime formulas, which means, in this case, a little bit more arithmetic than what we're dealing with this approach. So I'm going to back this up here a little bit. Present value for the moderate upgrade, minus 6,500 plus 3,300 to be multiplied by PA, present value 8% 7. So if we look that up, we're going to get 5.2064 plus, and I'm going to now change this to a minus because we have a minus inside this bracket here. So it's going to be minus 300, which is the decreasing profits as times go on. And we're going to multiply it by the factor that will change it from a gradient to an annuity. And that's going to be, I think it's 2.6937. And the next one, we're going to multiply it here, as it turns out to be the same factor as here. So it's the same number, 5.2064. And if we do all of that with the arithmetic, recognizing where the pluses are and the minuses are, we should end up here with a plus $6,473.78. So this will achieve the MAR at 8%. It will, however, and given that, the return will be $6,473.48. That is the value we have. However, we have two options here. Maybe the extended upgrade will prove better. It's going to cost more. The return may be a little better or less. We don't know yet. But let's take a look at it. So I'm going to start that on the on another page here. And to make the distinction, I'm going to say up here, first option. It's just so that I don't get the pages mixed up. Okay. So we'll just park that on the sidelines here. This here will be the same problem. It will be EOC 4.6. And this here will be, I'll put continued on here just so that I know. And I will call this the extended upgrade. So it is the second option. It's going to have a similar layout. It's running for 7 years. We have no problem there. And we're going to, however, deal with the fact that it is a geometric gradient in this case. The reason we know that is that although the return in the first year is going to be $7,600, it's going to decline 20% each year from the previous year. So that's not a linear relationship. That is a non-linear relationship. So I'm going to draw the diagram here. I'm just going to put my timeline in here. And I'm going to show again the annuity up here that's going to go, and I'm going to show our initial investment down here. So I'll put some numbers in here. This number here is going to be 10. Let me look at the question here. It's going to be 10,550. And it's going to run for 7 years. That has not changed. And it would have to be, you'll find, although we do not explore to any great degree, that if the years are not equal, in other words, if the another option has a greater life expectancy, we have to make an adjustment for that before we continue with our basic problem. I'll mention this, but I won't be going into any serious problems about that, but you should appreciate that for the study of your theory, that if this one here is for 7 years and this one here would last for 14 years, 7 and 14 are different durations. So we're going to have to use one of two techniques that are mentioned in the textbook as a way of equalizing that difference, if you will. And one is using the least common multiple method. And the other, I don't remember the name of it right now, but it's in the textbook, and I'll get you to take a look at that. So here, once again, though, we have a return on this, and the first part of the return is $7,000 in the first year, and we can build that out as an annuity here. And it is $7,600 per year. But this one is going to be decreasing. So here again, in preparing a proper cash flow diagram, we don't use a straight line. And you have to make that apparent to me when you're drawing your diagram. Now, it doesn't have to be ugly or anything, but then again, it doesn't have to be exact. But this is declining. And the decline will look something like this. Down to there. And in this case, we use a little g. A little g is equal to 20%. That's how much that profit is going to decrease, if you will. Okay, let me just make sure I have everything covered. This is a MAR, so we know our interest rate is MAR. MAR is equal to our interest rate I, and just like before, it's 8%. There's no compounding. It's we can treat that as an effective interest rate or a sub-period interest rate. Either way, we're going to come back to 8 when we do the arithmetic. Just a second, please. Yes, you do. Okay, thanks, Fabian. I see what you're saying there. I couldn't quite understand it. It is a minus 20. Fabian is correct on that. It's not showing up very well here, so I'm going to white this out here and just make sure it doesn't get missed, because that is important. G will be equal to minus 20%. The signage on those things is important, because if it were plus, it would be actually growing as the years go by, the profits. In this case, the profits are lessening, becoming less and less with the passing years. So that's what we should have. Thanks, Fabian, for picking that up here. Okay, so we now know we're dealing with a geometrical gradient, and we know in order to do that, we have a situation where we have to calculate I naught. We need to come up with a growth adjusted interest rate. And we know that that is equal to 1 plus I over 1 plus G minus 1. That's the formula. It's in the back of the book. It's in the formula. It's in the text of the chapter. But you need to know that whenever you have that, you have to calculate an adjusted interest rate, a growth adjusted interest rate. So what we'll have here, if we put this out this way, we're going to have 1 plus our interest rate, which is 0.08, and it's going to be over 1 plus, and I'm going to put a minus here, minus 0.2. And when we do all of that, we're going to end up, oops, sorry, minus 1. Gotta be careful here. Minus 1. And when we do that arithmetic, we should end up with 0.35, as it turns out, or if you like, 35% interest. Now, when we're using this, we cannot use tables. The rules are that, as it turns out, we are going to have to use the prime formulas to solve this. There's some good news in there, in that with the conversion of a geometrical gradient, it will convert directly to the present value. So in some regards, it's a little more complex, and in another regard, it's a little more straightforward. Excuse me. So we have that as our interest rate there, but we're going to have to recognize that. Now, I don't know, do we actually, we don't have a factor for that anyway, a factor table. It's not a factor in our tables, be a better way to word that. So we're going to have to do it this way. But keep in mind that when you're doing the arithmetic, when you're doing the geometrical gradient conversion, you end up with a present value, whereas if you do the arithmetic gradient, you end up with an annuity. Make that distinction. So here I'm going to put the present value, and I'm going to put a little e here. That's for the extended approach. Recall on the first one we used present value M for moderate. This is for extended, just to keep the calculations aligning to the question. So with that in mind, we're going to have again a first cost, which will be a negative, but for the factor formula, we can just state it as a first cost, plus the annuity onto what is present value. If we know that annuity, and we know G, I, and N. Now we can't, there is no table for this. So we have to use the factor formula. So I'm going to rewrite that right now. So the first cost won't change. So we can leave it as it is, because I'm going to have a fraction. I'm just going to drop that line down a little bit so I have room to make a proper fraction. we're going to have a first cost. That hasn't changed. Plus the annuity onto, and I'm going to use the prime formula here. We're going to have in brackets 1 plus I naught to the power of n minus 1 over I naught onto 1 plus I naught to the power of n multiplied by 1 over 1 plus g. So there's our formula in that regard. So now we're going to have to do, we can't use tables. I've said that probably way too many times in this case, but we're going to have to put values into this prime formula and do the arithmetic to come up with an answer. So I'll take the next step here and I'm going to drop it down here to make sure we have room. Again, first cost. Well, we know the first cost and we got to watch the signage now. It's a minus 10,550. Okay. The annuity for the first year return on that is 7,600 onto 1 plus I naught, which is 0.35 to the power of n, and n is 7, minus 1 onto 0.35 onto 1 plus 0.35 to the power of 7 multiplied by 1 over 1 plus, and I'm going to show that as a plus sign for the moment, but it's minus 20 or 0.2 as a decimal, end of bracket. So I can step this out a little bit for you as we go through it. You can just simply do all of that arithmetic and come up with your bottom line here. But I'll put a couple of extra lines in there just to give you a, so you're handling, because this computation, if you aren't totally familiar with using your calculator, may get a little messy. Also keep in mind that sometimes I naught in itself is a negative when you do these, so that you can't lose track of that when you're doing your arithmetic in these formulas here. Sometimes I naught would be a negative, so it's plus a negative. You got to factor that in too. It's not in this case, but again, I just bring your attention to that fact that the signage throughout the whole question is pretty important to come to the correct answer. So I'm going to put this in here. We have minus 10,550 plus, I'm just going to put it this way, 7,600 onto 1.35 to the power of 7 minus 1 over 0.35 onto 1.35 to the power of 7. And that again is 1 over 0.8. So I'll do it the way I worked it out before. We still have 10,000 here, 550. And if we multiply all of this out here, we should end up here with plus, and I'll leave it as a fraction with the numerator and denominator. I ended up here with 54,508.35 divided by 2.288 2263. Again, I like to carry a significant number of digits during the calculation. If you trunk off early and call this 2.3, then your answers are going to vary, and they may vary more than what I'll accept. So do not be shy on carrying significant figures considering the amount of time it takes seconds. So if you do that arithmetic here, you end up fortunately with a plus, and it is 13,271.47 cents. So therefore, in comparison to the first one that we did, this is showing that the value of the present value for the extended method is 13,000 as compared to that for the moderate is 6,000, and there's change all associated with that. So the extended upgrade is the better of the two options. This number is higher than that number. And the reason being is that it has the greater present worth. Hence, we're going to go with the present worth at that time. If both of these numbers were negative, if they were, they're not. Appreciate that. Again, both would not be acceptable, but if you felt you had to choose one, because the other machine that you're currently using is headed to, what are these things called here? It's an old ice cream maker. It's going to ice cream maker heaven. And because of that, you have no choice. You do nothing is not an option. If that's the case, you might have to take one if these were both negative. They're not. I want to underline that. You would then look for the one that is the least cost as the advantage. That would take you to choose this one because it has the least cost. So appreciate that, because sometimes the questions can be worded in such a way that you're dealing with having to choose between two options, but they're both negative, if you will. And if they're negative, you might want to look at the possibility of what you don't want to look at. You have to look at the possibility now that if you have to choose, it's kind of like the best of two worse, if you will. So you're going to end up choosing the lowest cost as opposed to the highest profit. So keep that in mind as well. Okay, I'll just park that on the side here. Let's take a look at 4.7. I think we have time to do that. Actually, I don't know if we do, because it is also, there's two offers being put up here. What I could do is we'll do the first one, and I don't know if we'll have enough time to do the second offer, but we'll pick up on our next lecture there, although it would be good if you continued it on your own. So what I'm going to do here is put, it's EOC 4.7, and when you read that, it's a software genius selling the rights to his new video game that he has developed. Two companies are offering him contracts. They're going to buy him out. They're going to buy out the copyright on it. The first contract offers $10,000 at the end of each year for the next 5 years, and then $20,000 per year for the following 10 years. The second offer, 10 payments starting at $10,000 at the end of the first year, and $13,000 at the end of the second, and so forth, increasing by $3,000 each year. So that second one is not an annuity on it to itself. It is an arithmetic gradient, because the profits you're getting over and above the first year are increasing by $3,000 each time. So we'll get to that, but let's at least try to do part A. So I'm going to indicate here that this is for the first, call it offer. And if we want to draw that cash flow, how long should it run for? Anybody tell me? How long should that cash flow run for? $15 years. Sounds good to me. So it's going to run for 15 years. And I don't know, we'll call this year one, but this has two components to it. So I'm going to lay this out. I don't know how well it'll work, but I'll say year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I'm going to run out of space. 11, and 15. Years. And they're telling us in this question that for the first 5 years, they're going to pay him $20,000 per year. So this is $20,000 per year. Then for the continuation, for the next 10 years, you're going to get, where am I here? I wrote down the wrong number there. I don't know if someone picked that up yet or not. Should be when I look back at my question here. The first contract offers him $10,000 per year for the first 5 years, and then $20,000 per year for the following 10 years. So we have another annuity here. And it's $20,000 per year. And the question says use the present worth comparison method. Also tells us that this software genius is wanting a MAR, or uses a MAR of 9%. In other words, if he can't get 9%, he's not interested in this venture. He's going to keep what he's got. But if he gets 9%, maybe it's time to move on with a good profit on his efforts, and maybe try to develop other software elsewhere for other applications. So we have here in this question, I believe, we're going to have perhaps a couple of steps to take here. The first one, I'm going to indicate, I'm going to treat this one here. So the present value for the first option, I'm going to call that P naught. It's going to be equal to the annuity. Note there's no cost involved here. We're not getting anything like that. So there's no first cost, but we are getting a return. And so we're just going to measure that on the basis of the return, if you will. In some cases, excuse me, please. In some cases, if the costs are the same for both options or for all of the options, as the case may be, it's not necessary because they're going to cancel each other out in the comparison process. In other words, it'll be the same amount, your cost to date, whatever's put on it. So what you can do is, as they are in this question, it's being set up in a way in which any cost to develop that software are simply being ignored. Not considered, not factored in. And that's fair to do because that applies to both options or both offers, won't matter. So it's not uncommon to do that. And that's what's happening in this question. So you see there are no first cost in terms of developing that software, or subsequent cost in developing that software. It'd be common to both offers that are coming in. So we can just ignore it. They cancel each other out, if you will, when we do the comparison of one to the other. So we have this, the annuity, and the question will be is what is the present value? If we know that annuity, we know NI and N. Well, I, we haven't put up here yet, but MAR, I should write it up here. I'm going to put it up here, space, I guess. MAR is our I value, is our 9%. It's not compounded, so we can use it directly as a yearly interest rate. Okay, and N, we've said in total will be 15, but in our case, this is an annuity within the overall cash flow. So this annuity is only going to run for 5 years. So putting some numbers in that, we would have 10,000 for the annuity. What is P? We know A. I is 9%. We have a table for that. And N is 5. And within that table of 9%, we have a value of 5 for N. So if we do that, we would have here 10,000. Pull that factor out. It'll be 3.8897. And if we do that multiplication, we will end up with $38,897. Okay, so that takes care of that. But now we have this second annuity that kicks in, because after the first 5 years, the offer for offer one says we'll continue to pay you for the remaining 10 years, but at $20,000 per year. So what we can do here is we're going to develop the present value of this annuity at the end of year 5, and then subsequently, as a single amount, bring it back to a present value at P0. So what I'm going to do here then is just simply say P5. And 5 is a subscript, meaning it's at the end of year 5 is what I'm after there. It's going to be very, very similar. It's going to be an annuity. It's going to be what is the present value. If we know that annuity, I and N. Putting those values in here, we have 20,000 in this case. PA, I is 9%. And the duration here, bringing this annuity here to here, is 10 years. So N will be 10. Using the numbers now, pulling the factor out, we're going to get 20,000 here. And the factor that we pull out will be 6.4177. And if we multiply that out, we get 128,354. But that's the present value at the end of year 5, or at the beginning of year 5 is what I should say here. And therefore, we will now move it from here back to here, but it's a single amount now. So I'm going to say P naught in this case will be equal to the future value. We can, we're going to deem this to be a future value. And we will say what is the present value of that future value if we know I and N. And that would be a value we just calculated onto PF I. Whoops, we know I, put the number in. 9%. And in this case, N is how much? Anybody want to tell me? It's 5. Yep, thank you. It's 5. So that will give us a value here of 128.
Excuse me, I think what someone was trying to tell you was you need to move your paper up there.
Okay, and I do appreciate that, and you don't have to excuse yourself. Just simply let me know. I apologize. Whoops, I'm really screwing up here. There we go. Hopefully that's good. Thank you for that so very, very much. 125. The factor here in this case will be 0.64993. I think it is 64993. And that will give us a value when we multiply that out to be 83 for 2111. So we now have that value. So our overall present value at time 0 is how much? Well, it's going to be, we're going to have to add up here. I'll put number 1 here. This is number 2. and this is number 3. But number 2 was just used to get to number 3. These are the present values. So we have to sum 1 plus 3. And if we do that, we end up with 38,897 plus 83,421. These are rounded off now. And that will give us an end result of 122,318. Clearly a positive, and it is achieving the MAR level of 9%. So where am I time-wise? We only have 10 minutes left. We can try to do it. We might run a couple minutes late, but we'll try to do it as well. So I want to do the other option. So this again will be EOC. I'll try to do the camera thing here in a minute. EOC, same number. It's going to be 4.7 continued. And in this case, it's offer 2, or so our cash flow diagram in this case is a little different. When I look back at the question, it's telling us that
Hey, Wayne,
yeah,
are you going to be going over the assignment at all?
I wasn't planning on it. It's, I hope, self-explanatory. I don't know if you've seen it yet. You probably haven't, because it doesn't open, or not supposed to open until 11. I guess if you want to take a few minutes at 11 o'clock and take a quick look at it, and if you have some quick questions, I am not opposed to it. I'm just trying to manage my time a little bit here because of commitments I have with other classes as well. But yeah, maybe. I won't go over it so much, but I'll let you take a look at it. But try not to open it until we finish this question, and then I'll give you a minute to open it and see what you think of it. It's a wordy question or problem, but it's using spreadsheets. The only time we use spreadsheets in this course is with the assignments. So what we do here is that we have a situation where we have one, they're going to pay here. I have to look at it in the textbook here. The second offers 10 payments starting at 10,000 at the end of the first, 13 at the end of the second, and so forth, increasing by 3,000 per year or each year. And the 10th payment will be that amount of money. So what we have here is our 10-year line in this case, not too bad. And we have a gradient because every year on the return, it starts out at 10, but then it's going to be 13, and then it's going to be 16, and then 19, and then 22, and so on until you cover the necessary 10 years. So we're going to have our gradient. We can describe that this way. Try it freehand here. And it's going to look like this. And that's our base annuity, if you will. And the base annuity is 10,000 per year, if you like. However, the gradient, and it's a straight line. So to make sure I make that proper, I'm going to use a ruler in this case. And it will be, G will be equal to 3,000. Okay. Now it's an arithmetic gradient. So when we're working with that, the end result will be yet another annuity. In essence, we're going to combine these two into a total annuity is what we're going to do. So the total annuity will be A, TOT, you'll recall that, is equal to A prime, the base annuity, plus the gradient onto A, G, I, and N. Now, in this, of course, the the MAR has not changed. So MAR is going to be equal to 9%. And we are still using, in both cases, the present value. So we're going to convert this as step one into a total annuity. So that will be 10,000 here for the base annuity. The gradient will be 3,000 onto what is, whoops, where am I here? Excuse me. There should be a plus sign here. 3,000. What is A? If we know G, I in this case is the 9%. And N in this case, we didn't mark it on our diagram, but it's 10 years. 10 years here. So again, we know that we are beginning, now that we use the tables a lot, we know we have a table where I is equal to 9, and within that table, N is available at 10. So we can proceed using the tables instead of a prime formula. So we're going to have 10,000 here plus 3,000 onto the factor. And if you pull that factor out, it will be 3.7978. And if we do the arithmetic around that, we're going to have $21,393.40. But all we have, that's per year. That's an annuity. We're going to now have to convert that annuity into a present value. So we can call that back here, present worth, present value, doesn't matter, at time 0 will be equal to the annuity onto what is the present value if we know that annuity, I naught and N. Okay, so we just calculated the total annuity, which is this value here. So we have 21,393.40 onto PA was the present value. We know the annuity. I is 9%, and N from our diagram is 10 years. This can now, we can now put the factor value in here, 21,939.40. And the factor value here is 6.4177. And if we multiply that out, we end up with $137,296.42. That's U for 2. So in looking back, the first offer was 100, I'll use round numbers here, was 122,000 and more. And the second one was 137 and more. So if you were the software genius, which one would you choose? Well, it would strike me that you would choose, and what I would write in here is something like because these questions will have a request or a must on giving a, what we call it here, a concluding or a decision statement. So the software genius should choose the contract from the second company. That should be N. Because it provides the greater return. Something
Can't
to
read
that
what you're
effect.
writing.
Pardon me? Oh,
I can't see what you're writing.
okay. Does that help? Hopefully you
Yeah.
can read my writing too. I'm kind of on speed mode right there. So I would write something like that. I'm pretty liberal on that. You could word that concluding statement probably in 10 or 20 different ways. You know, I just want you to select the right one and tell me which one you're selecting, because stopping here does not tell me which one you've chosen. So I want to know which one you're choosing and why. The reason being is that it provides the greater return, the greater amount of money. Which one would you choose? Well, you could choose either, but if you choose option one, here you're leaving roughly $15,000 on the table that you could have otherwise had. It doesn't make a lot of sense. Okay, I have that. So let's take a quick look at that assignment before I sign off here for today. I'll give you a chance to look at it, at least in Learn. You can probably download it if you so choose. And I'm going to minimize my, I'll bring it up on this screen too here, but I'll minimize this now. And let me just see where it is here. Okay, there it is. Give you a chance to read it. Try to answer. Is anyone else having trouble seeing it in Learn? And that's a good thing to check on if that's the case. It should be under in the Dropbox. Okay, good. You got it. So if one or two of you got it, it looks like my settings are correct and it's there for you to do. So I don't have to go there to see what I might have forgot. So you'll have to do this until April the 9th, which is a week and 2 weeks away minus 2 days, I guess, Saturday, Sunday. So you have almost 2 weeks to do this in. Don't leave it to the last because you will get another one probably next week to do that I will send out as well. Of a similar nature, you'll need spreadsheets, but this is to prepare a spreadsheet. So I want you to submit your spreadsheet to me. It can be in a PDF format. I'm okay with that, or it can be just in the Excel spread as an Excel document, or you can convert it to a PDF and send it in. I actually would prefer, now that I think about it, if you could send it in to me as an Excel document, and maybe I should put that on there for future. Send it to me as an Excel document. And what you're going to do here is you're going to select an interest rate and a number of compounding periods, and then program each cell standalone. Don't rely on previous cell information to calculate the factors for 10 different occasions. Now, there are some conditions, is that your interest rate cannot be reused. So once you use an interest rate, you cannot use it in the remaining columns, rows, excuse me, in the remaining rows. The number of compounding periods, you can duplicate them. Doesn't much matter to me. No, I'm sorry. In this case, I did change that this year. I'm sorry. You cannot repeat the interest rate or the compounding period. So do not use the same compounding period or interest rate in columns 1 and 2. Separate them out. So you could have, you cannot use one that's in the book. So you could say, I'm going to use 1.75. That's not in the book. Or I'm going to use 4.6. That's not in the book. You can't use 4. Can't use 3 or 2 or 5. But you can use 4.6. So you can use any of those. Compounding periods, you can use any length, but you cannot use the same one twice. So, yeah, I don't know, you can just go down 2, 4, 6, 8, 10, 12, something like that, whatever. Then by programming the cells, you can compute the necessary factor. And that's what you're going to submit for me for all 7 of those factors. Now, as a test, you could use, and I suggest you do that, you can use the numbers in the tables at the back of the book. So you might say, I programmed them all. I sure hope they're right when I program them, but maybe they're not. So what you could do is go to table appendix A and choose, put in I equal to 2 and N equal to 10. And if you've programmed it correctly, you should get the same values that are showing in the table for those 7 factors. If not, you've made a mistake. Once you've kind of tested your formulas with one from the book, you should ignore it, delete it, do not submit it, and then put in 10 of your own, because after all, you're going to be using the same formulas as you go down the columns, because you're going to use copy, paste, copy, paste, copy, paste. Okay, so that's the essence of it. What I do to mark this is everybody starts out with 5 points, and you lose a point for each column that's incorrect, and you also lose a point for each non-compliance with my instructions. So what could that mean? Well, one thing could be is that you use an interest rate that is in Appendix A. Well, you've been told not to do that. If you do it, you'll lose a mark. If you use a compounding period of 5 for every of the rows, or even for 2 of the rows, then you're not complying with the instructions. So read your assignment carefully. No, you cannot end up with negative marks. 0 is where you end up. Good question, sort of. So yeah, no, no, you'll go from 5 to 4 to 3 to 2 to 1 to 0, and then that's it. Most people score 4 or 5, many 5s, because it's you check it yourself with your own formulas, and that's usually the biggest mistake is you don't program the cell correctly in Excel using the arithmetical operations. But you can prove it by selecting any value in the tables with an N, an I, and an N. And of course, your value should then be the same as in that row of values from that table. Now you say, I got it, no problem there, but I can't submit that one because it's from the tables. So I'll make up my own from there on and put them in, and you'll probably end up with the same values, if you will, the correct values, and that's what you submit. But although I don't think I mentioned it, I'm going to for future years indicate that you must submit the Excel sheet. Do not use Excel functions. That is not complying. You need to program each one. Excel gives you a way, there's a way in Excel where you can look into the functions and the formula functions, and you can put in the numbers and it'll give you back the result. If you put in I, you put in N, and you put in your future value, you can say, what is the P value, and you got it. That's not the intent. So, do not use the, and I'm trying to look for my words in here, what you cannot use. You cannot use spreadsheet financial functions to do this. You must use, you must use arithmetical operations to compute it for yourself. And you cannot use the formula in a previous column and build on it to get the column you're looking at. You've got to program each cell as if it stands separate. It's not dependent on your programming in a previous cell if you're building it that way. I'm not sure what you mean, like PV minus PV, etc. Pavel. I'm not sure what you mean by that, except you're not calculating you're calculating the factor. So yes, if they come up negative, but I think all the factors should be positive unless your interest rate is negative. So you shouldn't use in negative interest rates. But I guess if you do, I'll follow through and I'll check it against my flexible spreadsheet, and that will take care of it. In other words, like if you were multiplying two numbers together, you could put multiply cell A1 by cell B1. Yeah, you can do that and use the multiplication symbol. That's arithmetic function, not a financial function. So you can use those by all means. Not sure what you mean. Maybe I'm missing something there, Pavel. I just don't quite understand what you're getting at. Okay. Yeah, we're pretty much done here now. If you want to sign off, I'm going to drop this screen. If you still have questions, I'm open to email. I'll see what I can do for you, but don't leave this to the last and realize another one is coming fairly shortly. It'll be probably in the latter part of this week or maybe over the weekend. And you'll have to work on it as your second assignment. I have yet to develop it. I think I want to use a new one for it over the one or two that I've been using in the past years. So that's what we have. Have a great rest of your week and enjoy your long weekend. But remember, you're still at school and use as much time as you can studying. Okay, we're down to not many participants left here, so I'll probably just sign off here.
Hey, Wayne.
Yeah.
For the quiz, you said it's not next Monday, it's the following Monday?
That's right. Yeah, our next live session, if you will, in the afternoon. Of course, it's after the session, but not Monday. We're not allowed to give lectures or contact. Well, we can contact you. I mean, it's like working on a Sunday, but you know, it's not. We're not supposed to lecture as if we have a class on Monday or Friday. I don't have you on Friday. I don't know who you have on Friday, but they're not supposed to do it either.
Okay.
Okay.
Okay, thank you.
You're very welcome, Kelly.